Russell Napeir, the financial historian, is predicting a period of structurally rising inflation. He made this prediction a year ago. Well, not transient as the Federal Reserve and some central bankers see it. Now, why is this news? Well, because Russell Napeir has got it right many times in the past. He began writing his now famous Solid Ground Global Macro Strategy Report for CLSA back in 1995. He forecast what was to become the Asian economic crisis, and he has been voted Asia's #1 equity strategist in all leading polls at that time. Napeir continues to write the Solid Ground Investment Report. He's also co-founder of the investment research portal, ERIC. Russell Napeir is also our guest today. Thank you very much, Russell Napeir, for joining us. A call of structurally rising inflation is particularly scary for a country like India, which tends to have a good 3-4 percentage points higher rate of inflation than the rest of the world. Well, what are your reasons, sir? There is a camp of transient inflation, which the Federal Reserve is espousing. You don't believe it's going to be so transient?
No, I don't. And the reason is a change in the way that money is made. So I'd go even further than that and say that the central banks of the world no longer control the supply of money, which is an extreme thing to say. The reason for that is that money is primarily made by commercial banks and not central banks. There's a wonderful article on that on the Bank of England's website. If I, as a government, can control the growth of the rate of the commercial bank's balance sheet, I can control the supply of money. And if I can control the supply of money, I will have an inordinate influence on the future rate of inflation. And that is where we are in the developed world. And it varies from country to country, but I think it's a necessity across the developed world. As you know, there's a role for the government of India in the Indian commercial banking system as well. But that's the fundamental reason why I think it's a structural inflation, is that the power to control money, and also I would say the power to determine the yield curve, which ultimately will be done through using the power of the regulator to force savings institutions to buy bonds. That also now rests with the government. So if the government control the price of money and the quantity of money, then we will have higher levels of inflation. That's the structural call.
What you are predicting is globally financial repression. Governments will keep bond yields down. So are you saying that the current bond yield is not reflecting the expected inflation?
So I'm not saying it's global. I'm saying it's going to happen in the developed world and in China. And the reason for focusing on those is debt to GDP. So this is one of the reasons for looking at India and being particularly interesting and exciting, because maybe in the Indian system, you can buck the trend, ignore some of the things that are going to happen in the West, and have a link between interest rates and inflation. And that ultimately is extremely good for the allocation of capital. You know, we mentioned the consequences of financial repression. The United Kingdom had it. We went bust in 1976 because we had it. You had it, and you went bust in 1990 because you had it. One of the great things I think about India is that it's because you've so recently experienced this and the downside of it and the inefficiency of the allocation of capital, that there will be politically a move against it, a realization as to where it ultimately ends up. And India is doing so many wonderful things and going in a different direction that I strongly hope that the politicians of India will avoid the mistakes that are being made in the West. And you couldn't be more excited about the outlook for India, and particularly in terms of capital inflows to India, if it does manage to buck these trends. So not a global phenomenon, but absolutely most of the developed world for sure. And that's a big portion of the world's financial assets. And if people try to escape that financial repression, and the history of the world really is that you should try to escape it, and India doesn't impose it, then India benefits with fairly significant, in fact, far too much and too high a inflow.
Okay. Well, yes, inflation targeting has just been recently adopted in India. And hopefully the political forces are also worried about inflation in the past. And maybe, therefore, we could step aside from the global phenomenon that you are forecasting. But Russell Napeir, what about cryptocurrencies and bitcoins? You think, if you think that easy money is going to continue in the developed markets, cryptocurrencies are also likely to continue? You think they will get more legitimacy?
Well, what I think is they cannot become currencies. Now, what we are talking about in financial repression is an attempt to move wealth from savers to debtors, from one section of society to the other. If you're a politician who wants to do that, you need to control the supply of money. The idea that a new currency comes along of which you have zero control a private sector currency. It's such huge competition, particularly in the era we live in today, for the developed world politicians, that I think they will ban it as a means of transaction. Now, banning something as a means of transaction does not rob it of value. Baseball cards have value. So that's the future for crypto. I don't know how you call the value of something that has no purpose, but it has no purpose. And no doubt there'll be people who make money going long it and people make money going short it. But it doesn't have a utility as a currency. It would be political suicide, I think, to allow that to happen in the developed world. So I don't invest in crypto for that reason, because I don't know how to value it if it has no utility. Gold, however, has shown utility as a store of value, and in very small amounts, even as a means of transaction, and as you know, in India, as an adornment as well. So
Yes.
I'll stick with gold rather than cryptocurrency.
Okay. So what would your pecking order of investments be? Would you say it should be equities, gold, and where would real estate figure?
Yeah, so it depends a lot on the time horizon, but let's just focus on the next couple of years. I think it's equities and then gold. There is still quite a long period to go before the market fully digests that we have permanently severed interest rates from the inflation rate, particularly in the developed world. And as that, I think we've just even seen it in the last few weeks, as the market really begins to realize that rates just aren't going up, then it begins to reprice equities and gold, I think, but maybe equities does slightly better than that. Real estate, and I have to, as I once again divide the developing world from the developed world. In the developed world, this repression forces governments to administratively, as you did during the license Raj, administratively interfere with the allocation of credit. Now, I think that means there'll be less credit available for commercial real estate, but there will be ample credit available for residential real estate, because that's what gets voters, is if you get plenty of credit flowing to residential voters. So in real estate, I think it's a mixed bag in the developed world, with much more positives from residential than there will be from commercial real estate. And in the very long run, gold is the best asset to own in the financial repression, not just because real rates stay low, but in the developed world, so far, financial repression has only been possible with the imposition of capital controls. And in a world of capital controls, the price of gold has usually benefited significantly, because it's one of the few assets that moves cross-border fairly seamlessly, certainly in small amounts. So gold is the asset for a long-term financial repression, but equities could well beat gold for the next few years.
Okay, and you don't see cryptos becoming partly attractive to those who look at gold? Can it be the gold of the millennials?
So I think the answer to that is no, because I don't see what utility it has. Now, I'm a bit long in the tooth for this business, but of cryptocurrencies. But if you take the word currency off the word crypto, then what is it? And what does it have that gold doesn't have? And that's the bit I can't understand. So I'm not investing in crypto. And there will be some horrific declines in crypto as we begin to realize that it can't have this function, because politically the consequences are too dire for it to have that function. On those days, the price will go down. I mean, the Chinese had banned it and it didn't have a large effect on the price, or at least it rebounded incredibly quickly. But if that, and when that spreads beyond China, then I think we'll see some significant downdrafts for crypto, at least in the short run. But gold would come more into its own in that scenario.
Russell Napeir, we've spoken a lot about inflation, but we haven't spoken about global growth. But let me start with India growth. There are a lot of people who worry that even after COVID, India's secular growth may not be the 7% it was in the first decade of the current century. It may probably settle a little lower, maybe 6%, because of some permanent loss of productivity that we may have suffered. Your first sense about how the Indian economy will evolve, and then the global backdrop.
Yeah, well, we have to put India in a relative terms, certainly in terms of what we do. And what we do is try to predict the future of capital rather than the future of economic growth per se. And on a relative basis, that's going to be attractive. And I think particularly attractive relative to China. I wrote many years ago, I wrote a piece comparing India and China, which I think some people may have found offensive, but it was called Buy Chaos and Sell Order. And and I said, and I argued in that piece, that out of the seeming chaos in India, which was 20 years ago, that order would form. And meanwhile, in China, which had created a very brittle system, a brittle exchange rate, a fairly brittle banking system, and a brittle capital allocation system, that would eventually crack. Now, it's taken a long time, if you like, for that Chinese system to. But when it does, I mean, China's been attracting such a huge proportion of capital, not just foreign portfolio flows in recent years, but over many, many years, foreign direct investment. India can get the one thing that any economy really needs to grow more rapidly, which is foreign savings. India has its own savings; they're rising rapidly. The means through which you utilize those are being, revolutionized by lots of wonderful domestic companies. If we add into that an easier ability to attract foreign capital, I don't think the lower real growth rate really matters. In fact, we could, if this capital is used wisely, actually see it accelerate. So in my opinion, there'll be an abundance of riches for India going forward, because for the first time really in a generation, it will have too much capital at too low a price. And that can lead you eventually to problems. I fully realize that. But it's a nice problem to have for many years.
Well, Mr. Napeir, I have to take a break. But for those of you who are listening in, the rest of the conversation will play out later on in the day. I'm bound by Bazaar timings, so we go into a break.
Brought